Trident Capital is a venture capital firm with more than $1.9 billion of capital under management. Kimon Boyiatjis, Chief Investment Officer at Trident Capital, joins us from our Cape Town studios to share their investment strategy. Kimon, I'm going to jump straight back into that financial conversation that we were having with Charles Booth just a moment ago. Given the latest news flow, and I'm not going to mention it again, but obviously at the center of it is ABSA. Is this a bigger element facing the whole financial industry in South Africa, or is it isolated to ABSA?
Bronwyn, in response to that question, I think we discussed a couple of months ago my concerns surrounding the financial stocks particularly. I've always viewed them as a higher risk than the rest of the investment market, largely because of the gearing effect of banks. My concern was that the assets weren't fairly valued and the write-offs were becoming faster than they'd previously anticipated. So I think there's two elements to this. The write-offs, where we're seeing consumers under pressure and businesses under pressure, and therefore the banks having to take the write-offs on the one hand. And on the other hand, while they are taking those write-offs, a lot of the assets that they held as security, I believe largely, if you look across the sector, those are overvalued. So even if they'd held property or any other immovable assets or shares or whatever the case may be, as security for the loans that they had extended, I think those are undervalued. And I suggest that possibly it's an industry-wide phenomenon. Maybe ABSA's seen the worst of it, I'm not quite sure, but I think the trend is there. And it's an international trend. And one of the things I always maintain, we can't escape international trends. So we've seen similar write-downs in Europe, certainly in the UK, and definitely in the US. All the banks have been under pressure, so there's no real reason why we should escape.
Kimon, earlier on, Charles Booth from Truffle Asset Management was saying that that type of view that you've just expressed is one of the reasons why he would be getting out of some of the consumer stocks, arguing that banks ultimately reflect the state of the consumer, getting out of the consumer stocks and starting to get slowly into some of the resource stocks. Would you agree with that? Do you think there's some value in the resource sector at the moment?
I'm concerned about the resource sector. There certainly is value when you look at a share like Anglo's. But if you looking to choose one of the two sectors, I'd be a little bit cautious, because with the certainly with the retail sector, yes, if you look at them, largely most of the stocks are overvalued. I prefer to take a defensive position and stay with the food retailers and cash retailers, because they're very cash generative. And again, I think you've got to be quite specific. Would I like to own a Pick n Pay, for example? No. Would I prefer to own a ShopRite? Yes. And the rationale behind that is not just the way the share's been performing on both those counters, but largely because I think the strategy for ShopRite is certainly definitely expansion into Africa, and they seem to have that right. So it's really the strategy when it comes to specific stocks. With the resource sector, I am a little bit cautious. I think the global economy is certainly under pressure. I think that pressure is not going to ease in the immediate future. I think Europe is certainly putting a dampener on things, at least for now. And the other thing that we mustn't forget is China. With respect to their growth, the numbers have been worse than usual.
Kimon, if I can,
8 months of steady decline.
If I can just interject there, you're cautious on financials, you're cautious on resources, you're not wild about retailers. Is there anything that you are keen on in the local or on the local equity front?
Look, I do think you want to be defensive. You want to own the likes of BATS. I think you've got to be specific. I like Bidvest has done well, Richemont's done well. So probably the industrials I'll be leaning towards. SA Breweries, I think, is a good hold. Sasol, I do believe at current levels represents some kind of value. And I'd like to think that is one area of the market we would like to be in. So across the board, I think there are elements. I am cautious when it comes to banks, and particularly I've been burnt myself. We thought we'd get into the banks a little early, and they haven't done particularly well for us. So we've got a small holding in the banks, but I am very cautious about them, and just really look to hold, with regards to the equity exposure, that is, quite a defensive portfolio. I think BATS is great. Look at cash generative stocks. And one of the signals that we look at, and in fact it's something that we always do, the minute a stock cuts its divvy and we happen to be holding it, it will be out of our portfolio. So we don't like that because we believe it's the beginning of a trend. So a defensive equity portfolio is really what I'm advocating right now.
Kimon, before we move on to talk about some of the asset classes, and I'm particularly keen to hear your view on the bond market, can you just quickly touch on the construction sector? It was another sector we chatted with Charles about. He said it's too early for construction. Would you agree with that? Is it still part of your defensive strategy to not really be looking at construction shares?
Yes, I think they're a little bit too speculative right now, and I think they're a little bit too risky. I think some projects have been cancelled in the past. These have got quite a negative impact. And I think because of that unknown, I prefer to avoid them right now. I'd rather jump into those kind of stocks when a clear trend has been established, because you've got plenty of time. When you do see those cycles, they tend to be quite lengthy in nature, and you do have time always to get into those stocks.
I'm still trying to find out.
Big jump.
I'm still trying to find out where the bulk of your money is. Now, I know that obviously you do like gold, the yellow metal, not the gold stocks in particular. And you've had a heavy holding, you then lightened your holding. Are we seeing any further accumulation on the yellow metal front?
No, still sticking between 5 and 7%. I can't see any real reason to move out of that. And if you look at this, a South African portfolio, and we believe if all your liabilities in South Africa, if your liabilities are here, then your assets must be here as well. So you don't want to diversify overseas. However, that 5% gold holding does give you some kind of hedge against the currency moves. So that's one of the reasons I'd like to include it in a local portfolio.
Kimon, can we just chat about some of the other asset classes to get a perspective of your view on that? Do you think, firstly, is there much value left in the local bond market, local government bonds? I mean, the yields have done well. There's generally been, I think, a better than expected performance out of the fixed interest space. Do you think there's more left in it?
Yes, I do. Kevin, when I look at the bond market, I do anticipate our yields coming down, despite the fact that we're actually quite negative on the rand. So I think while the rand can drift weaker, I think what we will see and have seen over the recent past is that the bond yields come lower. I do believe that you shouldn't have less than 20 to 25% in a balanced portfolio in bonds. Why? Quite frankly, what we are seeing is foreign investors looking for yield. We've seen the biggest inflow in any single month, I think, in the past 3 years, over the past month, if I'm not mistaken. So we have had heavy inflows, particularly from international investors who are looking to pick up yield in South Africa, certainly. And where they are going is certainly for the government bonds. So I'd anticipate at least for them to be stable, if not strengthened further. So I'd be looking at 20 to 25% in bonds, 20% in inflation linkers, which, as you know, is one of my favorite asset classes. I think it's prudent to hold that. 40% in equities, 5% in gold, and the rest in cash.
Kimon, in terms of your positive view on bonds, does listed property feature anywhere? I mean, obviously, again, the property sector's done well. Would you have it in the portfolio?
No. One of the reasons I think it's got to be an asset class on its own. So if you do have it in a portfolio, I would suggest not more than 10%. I'm not against it, but one of the reasons we don't include it in portfolios, or what we do, our portfolios are bespoke portfolios, so they're tailored for the specific client's needs, and our clients are institutional investors, so it is bulk money. What we tend to find, if I look at if I was managing a retail fund, which I'm not, I would possibly include some kind of retail, well, certainly retail property exposure, but not more than 10%. I do think there is a cyclicality to it. They have done particularly well.
Kimon, you've got 10 seconds left. You've got 10 seconds left. They're going to throw me off the desk in a moment.
Okay. No, in my average portfolio, not. And the real reason is because I think most people, private individuals, have got a big exposure to property anyway through their home.
Kimon,
so
thanks so
they
much.
don't need to actually get more exposure through their investment portfolio.
Kimon Boyiatjis is the Chief Investment Officer at Trident Capital. That's it for Investment 360 this evening.